Hello and welcome to the first ever Market Lens. I'm Sam Rozzi, the manager of Due Diligence, and I'm joined here by Cliff Walsh, our Chief Investment Officer at American Portfolios. We're very excited to start off this semi-monthly video series where we will be highlighting important market events and arming our financial advisors with very interesting talking points that are happening out in the financial markets. We will be splitting this show up into multiple segments, first starting with news or noise, and we'll be highlighting inflation. So inflation has been on the front of investors' minds recently, and we've seen a double-digit return for TIPS in 2020. Jerome Powell recently has spoke a lot about inflation, saying that he will do everything in his power to keep inflation in check. So do you believe inflation is news or noise?
I think it's noise, and I think that might surprise some people given how much the financial markets have reacted to the recent inflationary data and to Powell's comments and other issues. But I think there's a difference between reflation and runaway inflation. I'm not saying that prices aren't rising, they are. But I think it's a result of the economy reopening, having some issues with shutdowns and some supply constraints. You have some money that's coming back into the economy after kind of sitting on the sidelines with not being able to be spent on a variety of industries, travel, etc. So I think that we're going to see some reflation. It's going to put upward pressure on prices, but I do not think we're going to see lasting runaway inflation, which is what the market is pricing in at this point. And there's a couple of reasons for that. People are looking at what the government is doing, looking at $2 trillion spending package, or maybe a little bit less, compared to 2019. That's about 10% on GDP. So obviously, if all of that hit the economy, there would be significant upward pressure on pricing. But what we've seen in history is only about 25 to 30% actually hits the economy. A lot gets saved, debt pay down happens, especially during these trying times. People are going to have some precautionary savings and have probably accumulated some debt to kind of stay afloat during these times. So I don't think all that money is going to hit the economy. Also, people have looked at what the Fed has done with printing. That money also doesn't hit the economy. That goes to the financial markets. You've seen speculation in a variety of financial instruments. But if you look at the opposite side of the coin, velocity of money, it's plummeted. And what I think will happen is, when that money comes out of the economy, whether it's through Fed tightening or bond sales, you're going to see the velocity of money pick back up again. But right now, you got to look at both, and velocity of money has declined just as rapidly as the money supply has increased. As I said before, it's not like prices aren't rising, and I get it. We've seen 2.5% year-over-year growth in prices in December, went up to 3% in January, 3.3% in February. Obviously, I understand why the market is concerned. But when you look at history, we've had 30 years worth of data that we can go back on. 5 times we've seen inflation numbers get up to this point. A year later, every single time was below where it was at this point. So I think this is more just noise, normal volatility, kind of being upward pressure from inflation, but not going to be lasting inflation. And I think we haven't even talked about the employment cycle and how that will impact inflation. But my insight tells me you're going to ask me about it.
We'll get to employment in a second, but the Federal Reserve has said they'll do everything in their power to keep inflation under wraps so we don't go through a period like the 70s again. Do you think that is news or noise?
I think it's news because I think it's important. I think if we do see lasting inflation, the Fed's going to act. But they have said that they will let inflation run hot because they don't want to tighten too early and make the same mistake that they made at the end of 2018 that really sent the market into a nosedive. So yes, but I don't think we're going to see lasting inflation, so I don't think we'll see the Fed act too soon to try to tame inflation. I think it's just going to work its way out on its own.
Makes sense. Now on to employment. We've seen an interesting landscape where jobless claims have gone up, productivity has gone up, but compensation has actually ticked down. There was a recent ADP employment survey that's come in worse than expected at 117,000 non-farm jobs versus the expected 200,000 jobs added. And that was not the first miss on the employment side. Do you believe unemployment is news or noise?
I think it's news, and I think it's news for a couple of reasons. First, I think it validates my thoughts on inflation concerns being overdone. We still have a pretty significant employment gap in this country. If you look at the employment to population ratio, it's below any of the past 4 or 5 recessions. We're still at very significant recessionary levels, which makes sense. We've had a significant shutdown in the economy. Even when things start to open back up, we're still going to have a significant gap. Right now, we're at over 9+ million jobs compared to where we were in February of last year. That's a huge hurdle. If you look at the job creation that's happening, I mean, it will take 10 years to get back to that point. So it's definitely news from that perspective. When you also look at kind of how this trajectory of economic growth will happen, we're probably going to have a big surge out of the gate, sometime, mid-year this year into the end of the year. As a lot of industries open back up, people feel like they can go back out and spend. They want to go travel and do all these different things. You're going to see a big surge. But after that, it's going to peter out, I think, because you have a lot of concerns over personal income. You talked about wages coming down, on top of which we still have 9 million jobs, out there that have been lost. That's concerning from a consumer spending standpoint when you make up 70% of the economy from consumer spending. So I think it's news. I think it's important. I think it's going to create a lot of downward pressure on pricing from an inflation standpoint, but also economic growth.
Yeah, definitely an interesting environment there. We'll switch gears now to the market lens and zoom into the search for yields. The yield curve over the past year has made some very significant changes and now is at the steepest level that it's been since 2015 if you look at the spread between the 10-year and the 2-year Treasury. Rates are seemingly lower for longer here. But we've seen some move up recently on specifically the 10-year. Where do you think our financial advisors should go in the search for yields?
Well, I think, long bonds are starting to become attractive. I mean, we've seen a huge move off the bottom, in yields in March of last year. I mean, I think the 10-year hit 31 bips last year on that big surge. And, not a lot of bonds traded at those prices, but it was a crazy day and a crazy print. But to put things in perspective, we've had a 130 bip increase since then, or just about that. But 70 pips have been this year in just over 2 months. So it's been a pretty significant backup in yield. We're at 1.6%, in terms of the 10-year. Is that overly exciting from a historical standpoint? Absolutely not. But you have to look at more than just the aggregate level of yields. You have to look at relative yields. And when you look at other countries, $15 trillion of negatively yielding debt in the world. You have the dollar, which is potentially bottoming and rebounding, which will be a boon to foreign investors as they get the currency gains from investing here. It's attractive. And you also have to look at equities as well, right? Valuations are pretty high compared to the S&P dividend yield at 1.5%. The 10-year is above that number for the first time in a while. On top of that, you've got earnings yields, which are 5+%. So not overly exciting from kind of a valuation standpoint on other asset classes. So I do think that long bonds are getting attractive. Sentiment is very weak. You have to think about who else is left out there to sell. I think there could be some more downside. I mean, we could see the 10-year hit 1 3/4 or something like that, and maybe the 30-year hit 260 basis points or something like that. But I think that at that point, you're going to see a lot of investors jump in, and I think it's going to be, pretty, opportune time to look at long duration bonds. If you believe that's the case, you'll probably think value from an equity perspective, looks good because you have a very steep yield curve, or at least, the steepest it's been in probably 5 years. You mentioned the 10 and 2s. You've got, for the first time, an actual curve. Before it was pretty much just a straight line going across. We've got an actual curve now, and that suits value, and it suits financial stocks as well. So I think if you believe that it's going to sustain itself, I think it's going to be pretty interesting to hit those kind of 3 areas.
I agree. I think it's been very interesting to follow the Treasury yield curve over the past year. But yeah, thank you for your time here, and I thank everyone who tuned into the Market Lens today, and we hope that the Market Lens is helping you see 2020. See you next time.